Welcome to today's presentation. My name is Wynand. I'm the Managing Member of Winsome Wealth. Today we're going to talk about retirement funding. Winsome Wealth has been in retirement funding for more than a decade now. Over that time we've seen considerable change. But one of the things that members need the most is professionalism. So today you're going to be chatting to two certified financial planners, myself as well as Kate. She's joining me and we're going to talk about retirement. What does it actually mean? Kate, when we talk about retirement, where should we actually start?
I think let's start with today. Why do you work, Wynand?
Well, I work to pay for things, Kate. Things like my home, education, electricity, food, all the basics of life that we need, holidays even. Those are the things that I'm paying for.
And when you retire, which one of those things won't you need anymore?
But I'm going to need all of them, Kate. Life is going to be pretty much the same as it is today. I'm going to have the same needs then as what I have today. The same things that I'm paying for today, I'm going to need to pay for then. So what we've realized is that our needs don't actually really change in retirement, and we need to save now while we're working so that we can pay for the same needs that we have today in retirement.
I think most people are familiar with the concept of saving today for the future. But how many have actually thought about it? Wynand, how long will you work for?
Between 30 or 40 years, I would imagine.
Okay, and when you stop working, how long will you be retired for?
Well, I would imagine at least for 20 years. My gran is in her 80s, so at least for 20 years.
So if you're going to be retired for half the amount of time that you worked, does that mean that you're going to need to save half the money you earn now for retirement?
That's just not possible. I can't afford to take half of my pay now and save it for retirement. So it's just not going to work. I need to find another solution. As a matter of fact, if we look at most South Africans, they can only afford to save around 15%, and most retirement funds ask you to save around 15%. So let's do some basic maths, Kate. If we were to take that 15% and assume I earn a salary of 10,000 Rand, for the sake of the argument, and I save 15% of that 10,000 Rand, we multiply that by 12 months of the year, and the number of years that I work, on average, the person would have 720,000 Rand.
All right, so how long would that 720,000 last? If we take the 10,000 you're earning, we're not going to contribute to retirement anymore, so that gives us 8,500 that you have to spend. 720 divided by the 8,500 gives us 85 months. That works out to about 7 years. Wynand, you have a big problem because you're going to live for 20 years and you only have money for 7.
But how do I solve this problem, Kate?
You could work longer or save more.
Neither of those are very good options. I mean, it's just not possible to work until you're 90 or for me to save more than the 15% I'm currently already doing.
Well, you could use magic.
You're talking about the magic that Albert Einstein reportedly spoke about, the magic of compounding interest. If we were to add growth of 7% per annum to that money that we were saving every single month, then instead of the 720,000 Rand that we had, we would now have 3.9 million Rand after 40 years.
That number sounds a lot better. And if we take the 3.9 million divided by the 8,500 that we're spending, it now gives us 458 months, or 38 years. That's amazing. Sign me up for compound interest.
Absolutely. But you need to remember that if you're going to earn a higher return, you would have taken more risk to be able to earn that higher return, which means you would have been exposed to the volatile share markets.
That's true, and the share markets are very volatile. They move up and down on a daily basis. And the South African market over the last 12 months has been a really rocky ride.
This graphic shows the last 12 months between September 2014 and September 2015. If you had put 100 Rand in then, now you would only have 50 Rand.
But Wynand, isn't that like doing this?
Kate, it might feel like burning money, but in reality, prices move up and down every single day. And the short-term result is not as important as the long-term result. The next graph shows the market over the last 10 years. If we have a look at these numbers, it's a lot more pleasing to us. We can see the long-term growth, and over the short time periods, yes, things have moved up and down, but over the long-term time horizon, it's been a good ride.
But Wynand, what's that big dip in the middle? Is that 2008?
That's right. That was the financial crisis and one of the biggest falls ever in the share market. But take a look at the period directly after that time period. There was a huge recovery. and people who'd stayed in the market made good money over that time period.
I don't know, Wynand. Wouldn't it be less painful to just put your money in the bank? You get a set return every year. You don't have to go through all that pain.
I get what you're saying, Case. And over the short term, yes, that certainly seems very attractive. The problem with that is that one doesn't get any real growth. By real growth, we mean that your money needs to keep up with inflation. Take a look at this graph, which shows the Johannesburg All-Share Index versus the money market. Now, the money market grows very, very slowly, and you'll see that the All-Share Index has grown much more than the money market. If you had your money in a money market account, you would have lost real value over time.
I see what you're saying. Basically, the Rand amount that you have is going up, but what you can buy with that amount hasn't. If we look at this, the price of a can of vegetables from 1991 till now has gone up 1,000%.
And over the last 3 years alone, that same can of vegetables went up by more than 41%. If your money didn't keep up with that rate, then in real terms, your money lost value because money is worth what it can buy for us. In this instance of the can of vegetables, if your money hadn't grown at the same rate as the price of the can of vegetables, in real terms, your money has gone down. So to avoid this, we take market risk because the markets allow us to have above inflation growth. All of our funds are invested in balanced portfolios though. What do we mean by a balanced portfolio? Well, in terms of South African pension law, all funds have to invest in Regulation 28 compliant funds. Regulation 28 says that there's a limit on how much money we're allowed to invest in shares. And that limit is 75%. The balance is invested in things like bonds and cash, property as well. So not all your eggs are in one basket, which means that the risk is shared.
I see what you're saying, Wynand. Members can expect some ups and downs in the short term, but over the long term, they should have growth above inflation. Wynand, is there anything else that we need to think about for retirement?
Absolutely. Members should also have savings in their own personal capacity. The truth of the matter is that when people change jobs, they often cash out their pension or provident fund. This means that they're not going to get the 30 or 40 years that we spoke about, which means they're not going to get the full benefit of compounding growth over that time period. So the key is to have a plan other than your pension fund, that is, as well as your pension fund. You will need both.
And it's also important to start early. If you try and achieve a goal over a long term, it's much easier. If you think about it, if you have 30 years to achieve something, how much easier it is to achieve than trying to do the same thing in 5 years. There's a few things you can think about when you plan for retirement. One would be, where do you plan to live? Are you going to stay in the area you are now or relocate? Will you stay in the house you live in now or maybe downsize?
One of the key things is to actually have a look at the age that you retire at. In South Africa, as in many parts of the world, the norm is to retire at age 65, but it's actually a really outdated concept. It comes from the late 1800s when a German man by the name of Otto von Bismarck designed a pension fund. At that stage, less than 1% of people actually reached the age of 65 and could retire. Essentially what they were doing and saying is, look, work for us. If you happen to get to this terribly old age of 65, then we'll look after you. But today, when people get to age 65, they're not ready to step into their grave. They're still fit, active, and healthy, and they're still able to contribute in a big way to society, and they want to.
So maybe what you could do is start thinking about slowing down in your 60s, not working full-time anymore. But you could consult, for example, to a company, or maybe you could even make some money out of one of your hobbies. The key is really to keep active. You don't die when you retire, you keep living. So if you keep active, you'll have a better retirement, a happier retirement. And if you can make money out of it, even better.
The best time to plan for retirement is today. But you're going to need someone to help you to do that. Have a look on the FPI's website for a certified financial planner who's close to you. That's www.fpi.co.za. There a list of certified financial planners is, and you'll be able to see who's close to you, who you can trust, who will be able to genuinely help you. That wraps up our video presentation for today. Remember, your retirement belongs to you. No one's going to help you retire other than you. Start today. Don't delay. Thanks for joining us.